Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent. Today is going to be the second part of our series of three. The first one was covering EE bonds. Today is covering I bonds, and the next one will be a comparison between both bonds, which one is best for you. So we did already cover the EE bond and how it does double after 20 years to the face value. So the main differences on the I bonds here is that they are still considered a lending investment. Whoever you borrow or whoever you lend your money to, say a corporation or the government, they're still borrowing your money and using it. The government would use it for roads, schools, dams, wars, and other uses. Corporations might use it for sort of similar things, repairs and such. So the most common one, of course, is the government issued bonds. So you can make your way to treasurydirect.gov. I will have this in the description below so you guys can check this website out. You guys can make purchases on bonds through this website. And we're going to be checking out the I savings bonds, inflation adjusted bonds. So just like the name describes, these are safe and low risk products that help protect you from your savings from the inflation. Of course, these can be used to supplement your retirement income, meaning that you don't want to have all of them in bonds, all of your retirement income in bonds. You want to have it sort of split. Some of your money in stocks, some of your money in bonds for the long term. You can still give these out as a gift, and you can use them to pay for your education. And if you are using bonds, EE or I bonds, to pay for your education, they can be excluded partially or all, depending on the type of higher education and how it's done. Of course, what is an I bond? A security that earns interest based on combining a fixed rate and an inflation rate. So this combines two things instead of a fixed amount. This is a fixed rate plus an inflation rate. And we're going to do a comparison in the next video. So what interest does an I bond earn? The combination of a fixed rate and the inflation rate that can and usually does change twice a year. Of course, we know that this year our interest rate, or the inflation rate of the year, I think is 2.76. I could do a Google search, but I'm not worried about it right now. It's over 2% for the inflation. And again, is it taxable? Yes, it is taxable at the federal level, not at the state. And you can use the money earned to pay for higher education and keep you from paying federal tax on those savings bonds. So really important to note. I had mentioned in the earlier video, in the EE video, that if you purchase bonds, say if you're planning, a really good reason for purchasing bonds, especially EE bonds, is your EE bonds are guaranteed to double after 20 years. So if you do have a child who is in infant stage, or just below the 13, it's a good time to say you purchased a face value of 20,000 EE bond, and you pay $10,000 on it. It's guaranteed to double to its face value at $20,000 after 20 years. So by the time they reach the age of 20, now they have a $20,000 savings bond that they can go out, use for higher education. They can cash it out and use some of it to pay for their higher education and not have to pay taxes on it. Same thing with the I bonds, but these have a different set of rules, and that's what we're going to be covering here. So maximum purchase is still $10,000 per calendar year, meaning you can only buy up to $10,000 and up to $5,000 in paper I bonds. So let's see here, $10,000 each calendar year. For each security number, you may buy up to $10,000 in electronic I bonds and up to $5,000 in paper I bonds. So actually $15,000 you can buy per year. You can buy $10,000 of electric bonds, which is you buy those through the website, or you can buy in addition to $5,000 in paper. I have some paper bonds. I think that's primarily what I have. Available bonds, any amount. So same rules as the EE bonds. You can have any amount between $25 and $10,000 up to the penny. And I bonds are meant to be a long-term investment. They continue to earn interest for up to 30 years. Same rules apply. You can cash them after 1 year. You must, but if you do cash them before 5 years, you lose the last 3 months of interest. And if you cash them I bonds after 18 months, you only get the 15 months of interest. And of course, how do you buy a bond? You can go and create your account here on the Treasury Direct website yourself. All you need is your tax number, your email, your bank account information. You can route money in, decide on the savings bond you want to buy, and then buy it, and you would be issued an electronic savings bond. They don't do any more paper bonds. Everything is electronic these days. Let's go back here to right here. And we did cover a lot of this information. So IA bonds have two rates, a fixed rate of return, and then they have the variable inflation rate, which we're going to just jump in right to now. So right now, the composite rate for the I bond issued from May 1st to October 31st is 1.96. Now this percent blows out EE bonds out of the water. EE bonds, their current rate is 0.10, meaning that if you invested $20,000 for 10 years, you would make $200. But of course, if you wait those 10 additional years, it would automatically double to $20,000. That's basically an $18,000 gain, $18,800 just by waiting 10 additional years. On the other hand, this one, 1.96, if we put $10,000 at 1.96, after 10 years you would have about $12,000. And of course, if this continued for 30 years, it would be, I would say, maybe around 20,000. I can't do the math on this because if I click and drag this right now, it comes up with some funky numbers. I had to manually go through and add my calculations in there. So I might make another video. This is important. You guys would like to check out for the long-term 30 years of this. I could work on that, but right now I just want to get through a quick video. I don't want to have it too long. We're at 7 minutes now, so let's continue here. And of course, how do bonds earn interest? So here they compound semi-annually, so same rules as the EE bonds. They do compound semi-annually. Every 6 months, the bond issue date, all interest on the bond has earned in the previous 6 months is in the bond's new principal value. Interest is then earned on the new principal value. So if you have $10,000, I have a good example here. So semi-annually, you have 1%. Semi-annually, 1% of $10,000 is $100 in a year, but semi-annually it's $50. So semi-annually you would get $50, and at the end of the year you would include that original $10,050, and it would give you $50.25 instead of $50, because that would compound on top of your previously earned interest. And let's see here. So that's that rule. And of course, the interest on the I bond is a combination of fixed rate and the inflation rate. And they do have a savings bond calculator, and it breaks up what the fixed rate is and what the inflation rate is. And there's a good little graph right here that shows the fixed rate right now is 0.00%, and the semi-annual inflation rate is 0.98%. So they have like a breakdown of the calculation and the composite rate and the composite rate in a decimal form, and then they break it into a percentage form. So by the fixed rate is 0.00% right now. That wasn't always the case. The semi-inflation rate is what changes, but when you purchase the I bond, you purchase it at a fixed rate. It's the semi-inflation rate that changes. And they have it right down here. So if you purchased bonds in 2010, before that they had decent fixed interest rates, then you had a fixed interest rate guaranteed no matter what, plus they added their own inflation rate. Right now there is no inflation there is no fixed rate. It's it's very low, 0%, but they do add an inflation rate of 0.98%. So I actually have an example of this that I can showcase. This is 2017. These are some of the savings bonds that I currently have, and if we look at these I ones here, you can see that on the right hand side all of mine have some sort of an inflation. Let's see here, the lowest one of course of mine is 1.96. so this one right here was purchased in 2008 of May. So if we go back and we look at May of 2008, the interest was 0%. So right now they have a good inflation number, but if the inflation number was really bad a year, which I have an example right here, we can take a look at that same exact one. We can see that in the year, where is it? Here. In the year 2015, I believe, 17, 16, 15, 14, and 2014, I had no fixed rate. I was mainly just on the inflation rate, and because it had no inflation issued on May 2008, I actually earned no interest that year on that specific bond. So throughout the whole year, not having any interest on that bond kind of killed it off. But it did pick up in 2015 and 2016. It kind of went down again. It still had semi. You can see these low numbers here. But the inflation rate and the fixed rate that you buy it are the most important things to look at when you're purchasing I bonds. You can see that right now in the year 2017, I do have a couple I bonds that are over 4%. These are ones that were purchased in 2006, 2007. So we'll say 6, 7. Let's go take a look at our chart. 6 and 7. 2006 and 2007. The fixed rate was 1.4, 1.3, 1.2. So a good decent range. Plus the inflation rate is added onto that. So the inflation rate's like 1.96 right now on top of the 1.4, which is what gets me that 4% interest rate. So good returns right there on the I bonds. Will they be able to match the EE bonds? Say in 20 years, the denom for these E bonds are $1,000, meaning that I paid $500 for them. I won't go into, actually I can do this in my next video. I'll break it up because we're going to do a comparison. So this will actually be saved for the next video when we begin comparing our EE bonds and I bonds. If you guys want to take a look at your comparison yourself, you can do that, or you can just wait for my next video. So that is it for this video. I didn't want to make it too long. Again, hopefully you guys have learned some information on savings bonds. I think that both of them serve a good common, they both serve a purpose. You just have to know which one to buy for whatever you're trying to use it for. And you want to look at both of the fixed rates because both of them do have a fixed rate, but one, the I bond, has an inflation rate that adjusts with the year inflation. So it's important to look at that too. So that is it for this video. And of course, I want to thank everyone for watching up until this point. If you did like the video, hit the like button. If you like these sort of videos, remember to subscribe because I will be putting out additional information on financial and investment type videos, how to get financially set for the future. My resource page does have a lot of free stock tools to get used. To get information to screen for stocks, so check that out. There will be a link on the left side, like a little icon you can click. If you have any questions about any I bonds, E bonds, or stock market questions, go ahead and leave that in the comments below and I will always reply. Thanks for tuning in, and I will see you next time. Bye.